What's going on, guys? So in this episode, we're going to be talking about how to day trade for beginner traders and how to get a good jump start to start understanding day trading before you go and spend money on a course or spend money and just immediately go right into the market. So this is just going to give you a brief introduction of kind of what day trading is. All right, so what is day trading? Day trading is the buying and selling a stock within the trading hours. So the day trading hours are 9:30 to 4 p.m. Eastern Standard Time, Monday through Friday. And some days you get off, such as Christmas and important federal holidays. You guys get the days off. The average day trader only holds stocks for minutes. You rarely ever hold it for hours. That's when you start getting into swing trading, is when you hold it for more than a day, but less than a year. So that's what day trading is, just a single day trade. So how does day trading work? Well, in simple terms, day traders buy a stock that they want to go up or down depending on what kind of style of trader you are, because you can short stocks, so meaning you're kind of betting against them. So day trading profits from high volatility, and volatility is the measure of the security's ability and is usually calculated as the standard deviation over a given period of time. So that means just kind of okay, so if you have a stock that normally trades, anywhere from 1 to 3% a day, and then the stock gets a 25% gap up, that's volatility. So volatility, there's going to be a lot more people looking at that stock. There's going to be big spreads, stuff like that. But we'll dive into that more. And it's our job as day traders to find the stocks by finding a good catalyst. And this catalysts are such as high volume, news, an earnings report, or really any other major news. And why 90% of traders fail. So this is kind of a very important slide, because if you say to your friends or family, yeah, I'm a day trader, they're going to say, oh, that's so risky, that's but it's the same thing with anything. Day trading takes time and practice. You think that a heart surgeon can just perform surgery right out of high school? No, they take practice, they go through years of schooling. And so it's very similar, but it's not years of schooling. You can become a proficient day trader in less than 2 years. That's about the given average time. But it's very hard for people because they want to get rich quick, and then when they lose money, they say, okay, I'm done, and they don't take the time to understand what they did wrong, how they can improve. So, and another thing is they don't understand the risk versus reward. This is very important. A lot of high-end traders, that's how they make money, is they understand their risk. So that when they buy a stock, they understand, okay, so we're at the resistance level. So the lowest risk I'm going to take is $100, and my reward will be $1,000 if all goes well. So that's the kind of stuff that you guys should be starting to say when taking a trade. And then another reason is they lack the knowledge to day trade. They gamble and they don't understand the market. And this one's kind of similar to the first one, how it takes time to understand what you're doing, and you just don't throw out your money because no one wants to see their money go away. And how to find hot stocks daily. This one's kind of an easier question. Is the most common way are stock screeners. They filter all 15,000 stocks, out there in the market, and they see which ones have high volume, gap ups. That's what I look for. I look up for gap ups during pre-market hours, and then those stocks during when the market opens always gets high volatility. A lot of people, high volume. That's the stuff we look for, though. And you can another way to find hot stocks or staying involved in the business news. So if that's, say, Facebook at 2 p.m., Facebook released a statement saying, let's say their software's been hacked, then that is not that's a major news, but it's not a good major news. So that would be where you could watch it and look for an opportunity to short it or to bet against it. And then you always want to make a scanner during market hours, or you can buy one. They're called Momo scanners. You guys can find them. You just gotta look them up on the internet, or just make one. Alright, so strategy. Having a strategy is one of the most important things a trader should have. Before you take a trade, you should make sure that you have a stop loss. This ensures that you don't lose all your money. And my stop loss is about anywhere from 3 to 5%. I always when I first start an account, I always have a little tighter stop loss, just because I don't want to, if I have $1,000 account, I don't want to lose $500 on one trade. That's half my account. So that's half my account, and I would lose 3%. So 3% of $1,000, $30, and to have an upswing of around 150 starting out. And a very another basic strategy is the support and resistance bounces. As you guys can see, if a stock hits that support and immediately gets rejected, that would be a good buy point right there. And when the first, I always buy when the green candle beats the red, just so I can have that kind of confirmation there. Alright, strategy continued. If a stock is at 380 and the resistance is at 425, you would start selling off at around 420. Don't sell all your stocks at 425. Understand that a breakout could happen. So if you have a stock and it's moving up, and there's a resistance at, let's say, 425, and if it breaks that resistance, that's called a resistance breakout, and we look for those. So we would just continue to hold it until the first pullback, and then we could start selling out. But before that resistance line, if you guys are already in profit, and I would recommend just start taking profit along the way at that resistance line, still be holding 200 shares, something that you could just get out real quick. And if it breaks over that, then just sell out. Alright, another strategy is called the gap and go. This one is my bread and butter. I love this with everything. So when a stock goes up more than 4% pre-market hours, it's called a gap up, pre-market gap up. And so I try to look for quick and easy trades that I can profit by 10 a.m. So you can make $500 within 30 minutes. So if you have a stock that gaps up 25%, and you say, okay, let's see for a good entry, because right when it opens, you most likely will either get a huge sell-off and then a reversal, like the stock just declines, or you will get a continued trend of a upward trend, and you could profit right out of the get-go. Right when it beats the pre-market highs, that's a good entry, or on the first pullback is another good entry. So that's one of my strategies. And then how to find those stocks is you scan for gap ups more than 4% using TD trade idea scanner. Sorry. And then you hunt for the catalyst for the gap. So if you have Apple that went up 25%, that will probably never happen. But if you had that, then you'd go in on Market Watch and see what's kind of going on. Mark out pre-market highs and high of any pre-market flags. A good gap will hold the top of the gap. A bad gap will sell off pre-market. So you want it a continued holding the highs pretty well to distinguish between a good and a bad stock. Prepare the order to buy at the pre-market highs once the market opens. At 10 a.m., as soon as the bell goes off, buy the highs of the first candle, of the first 1 minute candle, this with a stop loss with the low of the candle or the pre-market highs, or buy the pre-market highs, sorry. So if that's kind of confusing, just kind of screenshot this and kind of go through it. It'll make more sense because I think I kind of butchered it when I was saying it. Gap and go characteristics. So this is kind of when I find those stocks, this is what I look for. I look for a float less than 20 million shares, a short interest greater than 10%, a good catalyst, a former runner or a former gap up, hot stock with a lot of retail interest, pre-market volume above 150,000 shares. And then another strategy that I use, but this one's more like at the 10 o'clock to 10:30 spin is when I start to use patterns. So here we go. So there's the bull flag pattern is when you get the flag pull, and then you get the flag. Flag is kind of the consolidation, and then for that kind of trade, you'd want to buy on the first green candle that beats the red. So that would be a good entry for a continued gap up. Another basic pattern to look for is the flat top pattern. So this is when you get a trend. Let's say you get a trend moving up, and then a consolidation, and then a gap up. So the flat top is really just marking out the support or the resistance lines, and then you do the resistance breakout like I was talking to you guys about earlier. So with there's thousands of patterns out there, and I just recommend specializing in 2 when you're first starting out, because it's better to learn 2 patterns and practice them and to understand them than to learn 10 and not fully understand how to trade them. So when you guys first start out, you guys are going to be running into this problem. It's called the pattern day trader rule. It states that if a trader takes 3 or more day trades in a 5-day trading period, then they are a day trader and must maintain a minimum account balance of $25,000. But many traders who are unable to maintain that balance will, they will trade at either at a prop firm or a sure trader or trade zero. So if you guys are first starting out, you guys don't want to day trade 5 days a week. You just want to kind of get your feet in the water and kind of learn the ropes. So you guys can just use like TD Ameritrade. That one's a good one. But I always recommend using simulation before you guys jump into it, and then you guys can open up an account at Sure Trader and then transfer to Lightspeed. So, and another major idea that you guys have to understand are what is a bull market? Bull market is just a strong market, and it's moving up in trend. And then a bear market refers to a weak market, and this is kind of just going down in price, and that's called bearish Bear, a lot of people tend to short the stock, and bull, they tend to buy it. Sorry, I kind of have a stuffy nose here, but blue chip stocks, these are companies that are worth billions. They pay dividends, have a long, reliable history, and they're kind of like Apple, Amazon, and Ford. But there are thousands of them. Also, blue chip stocks are great for portfolio and for kind of retirement investing. And penny stocks are kind of like those stocks that we day trade because they get more volatility. They move faster. Okay, so this is what I recommend doing for you guys' homework. Create a watch list. Use Market Watch or Thinkorswim's paper money to simulate day or stock trading. Study it and create a strategy that works for you. Look for a couple patterns, and then there's a free stock screener at findes.com. So if you guys want to do that, make sure you guys understand the PDT rule because that's very important. So that's going to be it, though, I'm pretty sure. Hope everybody enjoyed this video. Please sure to hit the subscribe button and let me know what you guys think. Thanks for watching, guys.